even at the most pessimistic scenario, it's not that much more than what you're seeing on fixed versus variable. So really run the numbers.
You got all that right? Well, unfortunately, our 10 seconds of fame on CTV probably wasn't enough to have you really visualize what did Paul mean by running the numbers. So what I'll talk about in this video is actually illustrate to you that the gains you get today at the lowest variable, as that starts to be reduced over time, even based off the most pessimistic scenarios of variable rates going up by 2% from what they are today to in the next 2 years, you'll start to see that what you save right now can be A, invested, and B, when you look at the whole grand picture, you're not that much worse off, even if the worst case does happen. So I'll show you kind of what to look at. You have to make your own decisions, your own calculated risks. It's all about trade-offs, but let's actually dive in to see a couple scenarios on rough ballpark numbers. Okay, so diving in, number one, let's look at what's on the far right here. Here is how the prime rate has changed over the last decade. Here's some averages. It doesn't mean that what's happened in the past is indicative of the future because it is an inflationary period. However, keep these ranges in mind and you'll see that at no point does it go up 2%. This is something that was predicted by an economist at Scotiabank. They, of course, always like to make their headlines. But look, we'll play conservative in this estimate, but just know that these are some fluctuations, and the fluctuations don't usually last that long. So make sure you look at the past before you are anxious about the future. Number one, okay? So let's run into it. So right now, the prime rate, right, is 2.45, right? That's kind of what you get charged on, let's say, a line of credit. And that's how your, of course, your interest rate is quoted. So if you have a 1.45 now, which is, a common one that I'm seeing for lowest variable, that I've seen as low as 1.2, it would be prime minus 1, right? So let's say your mortgage is $750,000. I'm purposely going for a higher mortgage. A lot of people that I'm talking to right now, of course, are buying townhomes and detached, and they are bigger mortgages. So let's look at, the scenario of, okay, well, Paul, if I do a fixed today, will I regret it for the next 5 years? If I do a variable, will I regret picking that over what I could have been at 2.45? So let's just stick with 2.45 as the anchor, which right now is one of the lower fixed rates. So real quick, we're going to do a 30-year amortization, okay? It's going to be for year one, right? Because they're predicting that the first year, starting now, right, is going to probably stay at the exact same, right? So that means in the first year, you're paying at 1.45 variable, 906 of interest per month. That's a portion of your total payment. The rest goes to principal, right? And then that delta, the difference of that 1% is you're saving 625 a month of interest in a year, right? You can see the cells are, of course, linked up. You'll see that it equates to about this, okay? Now, of course, if this best case scenario stays forever, you'll be a rich person, but likely won't happen. But it's good to see kind of the 5-year projections if things stay status quo, okay? So first year, you've got this much in the bank. This is huge, and if you save this money, then you'll be much better off. If you spend this foolishly, then this might be for nothing. So there's all about savings as well. Now, second case, potential, probably most likely actually, is that net it goes up by 1%. So after a year, your 750 is now around 728. And keep in mind that monthly you pay less and less interest, but I'm just keeping it constant. So we're just going to say that, on average monthly it's $1,487. Again, this is what you would be paying if you had stuck at 2.45 fixed. Now variable and fixed are at par. It went up by 1% in the year, so there's really no gain, no loss. But that $7,500 is now at $8,400 based off you investing it at a 12% return, which will likely happen if inflation goes up because, of course, the stock market gives more returns when that happens, right? And of course, if that stayed for the next 5 years, then you would compound this amount of money here at 12%, right? And you'd be at just under 12K. Okay, so that's kind of, I think a very potential case. But let's, of course, get to what we all want to focus on. The worst case scenario, what was predicted by Scotiabank, goes up another 1%. So now prime is at 4.45. After the second year, you're now at 711, right, for your total amount of mortgage. Again, if you had stuck with that 2.45, this would be your interest rate. If you were, I guess, at variable and you had not already switched to fixed, remember you can always switch to fixed, we'll talk about that in a moment. This would be how much you're paying in month of interest now, because you're paying 1% more now than you would have if you would have stayed at a fix of 245. That's how much you're losing per month, which of course is less than at the beginning, because again, there's less on the mortgage. Keep that in mind. Yearly loss is about $7,000. At the end of year 3, you subtract this yearly loss with what you had been saving, of course, very responsibly. You're still at a net gain. Now, the question is, will this 4.45 stay for the next 2 years? And that's, hard to tell. Again, if you look at the beginning, the prime rate history, at one point, yes, it did stay for a couple years. In other examples, it can fluctuate a lot faster. It really, really depends, right? So let's assume that it does stay like that for the next 2 years, or you have a feeling it will, and there's speculation that it's gonna stay like that. Okay, then what do you do? So obviously, look, if you, number one is you can lock into a fixed rate, okay? And that is done for free. So the gain is you cut your losses and you stay at net this. And this is, of course, assuming the fixed rate at this point will be at 3.45 or less, which is very likely. Of course, the consideration is that, well, what if the fixed rates are a lot higher? Well, then yes, you would have been better off at a 2.45, 5 years ago. But again, what the likelihood of that? Something you got to think about, right? My prediction is probably going to be around the same. Okay. Again, we're still at worst case. The other one is actually very overlooked. Is look, even at this point, right? Even at this point, if I'm maybe moving to another home. In other words, I'm selling, or there's a chance I might want to refinance. Remember, there's still usually a 66% chance you will break your fixed rate mortgage. So if anything, the expected value is that you're going to pay around $20,000 for a mortgage this big, right? And there's a 66% chance of that happening, which means that with you staying at variable, you are actually potentially saving what would be a $13,200 penalty. That's, of course, me using expected value, right? $20,000 what it would be at on average. If you times that by 0.66, which is the amount of people that usually break it, right? 2/3, and that happens in the third year, by the way, you can dodge this. So, if you're thinking optimistically like this and with a bit of foresight, obviously the gain is you avoid paying $13,200, which therefore means even if you're still paying the highest variable rate, you're still net positive because you've avoided this to pay a little bit more. Again, another way of thinking about it, not something you have to cling on to, but please look at the whole picture. There's some hidden costs you always have to keep into consideration. And then, those are kind of the two things to consider. So in summary, again, at a worst case, how bad off are you really? Well, it depends what moves you do after year 3. More than likely, especially if you save your money responsibly, you will be in the net positive, and you will not be going to sleep with this nightmare looming over your head, which again is very, very likely. So again, this is all about trade-offs. It's your mortgage, it's your life, it's your predictions, but please take a broad look at the numbers and understand that there's a huge gain to be made right now that can be capitalized if you save it and invest it wisely. Okay, hope that helps. So, to conclude, and a disclaimer, these are rough numbers. It's meant to have you think about things a little bit differently, see the whole picture, and again, make predictions on your own end. In fact, I would invite discussion. I would invite opposing views. The whole point is to get people really looking at different perspectives, running different scenarios, and ultimately it's up to you to make the decision. I will actually link that Excel document. I'll make a draft for you to be able to download, make a copy of, and run your own scenarios. But again, it pains me when people cling on to headlines and make emotional decisions, not thinking about the whole picture. So once again, trade-offs, running the numbers. Hopefully that was helpful. If you have any questions, of course, you know how to reach me. Thank you so much.